Welcome back to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth. Online, you can find us at zinniawealth.com, ZINNIA wealth.com. If it's time to talk about your retirement, we're here to listen, and we are here to help. You can set up a time by giving us a call as well, 833-368-3680. Well, you've probably heard Sharice and I use the term buckets of money. That means you have different buckets of savings. There's savings, there's Social Security, maybe there's a pension, there's a 401k. So the one thing that we want to make sure of is how big is the hole in your bucket? Because you're taking money out, that's a hole in the bucket, but are there other holes in your bucket? That could be taxes, that could be your withdrawals, that could be fees. And a lot of people don't know too much about the fees in the financial industry because the financial industry doesn't like to talk about it. But one guy who does is Tony Robbins. And Tony's book is right there at Sharice's bedside just recently. She's been going through it. And Tony was just recently on one of the morning shows, and he was talking about 401k fees.
65% of America thinks they pay no 401k fees whatsoever. There's a reason. For 30 years, this industry, $4.4 trillion industry, didn't have to tell you what they charged you. 3 years ago, they had to do it, so then it makes 35 to 50-page documents you'll never figure out. Right. So here's what you need to know. For every 1% you're paying, that's 10 years of income. At the end of retirement, you're going to lose. The average real fee is 3.1%.
Now, that is shocking to me, Sharice. 3.1%. And 1% is 10 years worth of retirement. That means somebody else is getting 30 years of my retirement money.
Yes.
That is a wake-up call. And what do we do about this? And what can you tell me?
I mean, I have $1 million in retirement, and a 1% fee, it's going to cost you over $300,000 of that million. That will grow, of course.
Gosh.
But if you put that $300,000 back into your pocket over the next 30 years, or gift it, or give it to your kids, or reinvest it, there's a lot more things that you can do and enjoy with that. So I really want to hone in on this fee segment, because if we can save new people who are coming to our office an average of 0.5% to 1% in fees based on where they sit today, it is amazing. I mean, every dollar counts, right? So let's talk about those 401ks, because Tony Robbins really harps on those 401ks in his book. A lot of people don't know this. They're like, no, I don't have any fees on my 401k, Sharice. Well, no, there's not a line item. You're not going to see it. Do you think the fund managers inside your 401ks get paid? The answer is yes. They do not do it for free. They got trillions of dollars in there. It'd be too good to be true. So you do need to understand this. The fees sometimes get so high in these 401ks that the government has been getting involved, saying, you know what, you're right, this is wrong. And they're trying to get control of that, but it's huge. And
there's been lawsuits over that.
Oh yeah, definitely. I mean, look at the target retirement date funds. Let's say the 2030 target retirement date fund. It's just saying, hey, we're probably going to retire in 2030, and every year we're just going to get a little bit more conservative as we go. And it could be in Vanguard, and it could be Fidelity. But don't you think Vanguard and Fidelity want to get paid?
Sure.
And there's some administration fees, all that. Yes, I have seen 2% and 3% in fees in 401ks, but the average is probably 1%, truly, but it's a lot, in my opinion, when you could have like 0.5%. Just saving 0.5% is a big deal.
Yeah.
So what I want the listeners to think about is, when you are 59 and a half, do you know that you can do an in-service distribution, meaning you can take 50% from your 401k and roll it to an IRA, or 25, or sometimes 100%. And then you can move it to an IRA that potentially has a lot lower fees. And now you can kind of create a plan with a local advisor as you're getting closer to retirement. That is key. I will say 98% of the time, this is a true statement. You can roll it, no taxes, no penalty. And at the same time, you can keep contributing to that 401k, and they'll keep giving you your match, which is really important. But let's talk about those old 401ks from your old employers. Let's say you're working and maybe you're only 50 or 45 or 40, whatever it is. If you're 40 and you're listening to the show, I am proud of you. Pat yourself in the back, number one. But you have an old 401k. Most people do when they come in, and you just leave it there, and you don't really understand the fees involved and the nothingness that's going inside of them. Today, we're starting to see a lot of people move their old 401ks to the new 401k with a new employer. And we say that is not advisable. You can roll that old 401k, it doesn't matter how old you are, to an IRA locally with anybody you want to work with. And there's no taxes, there's no penalties. It's a beautiful thing. So don't be afraid of it. Just know that it is available. And, be diversified. Find that fiduciary advisory team that works best for you. We hope it's Zinnia, of course, but, really, you got to pick and be prudent to who you want to manage your investments for the next 30 years in retirement. So be careful with 401k fees, and we can help figure out can you or can't you, et cetera.
One thing that we've talked about in that old 401k, Charisse, is fees for smaller company 401ks tend to be bigger than the fees for bigger companies. So if you work for AT&T or something like that, you work for Home Depot, a big company, and that, if it's Fidelity or Vanguard, they are managing lots of employees' money. So they charge one, fee for that. But if you work for a company that has 100 people or 20 people or something like that, those 401ks tend to be a little bit more expensive. So you need to know that if you've left a job from a small company with a 401k.
It's so true. I mean, when we started our retirement plans here at Zinnia for the team, I remember they were saying, well, you can charge this fee, it could come out of their account, and then Zinnia makes this much money by managing the 401k. I'm like, no, I don't want my team paying any fees. I need them to save money. That's what we're trying to do here. It was amazing what you could fluff inside and nobody would know. I was like, no, I want, if there's any fees, I'm paying for it. They're like, okay. But now you have this 401k, and either you're under 59 and a half or you're over, whatever, but you can start moving monies around. And now your money is officially landed into a regular IRA or a Roth IRA. And then what happens is these advisors, this is the next step of fees. You got to be buyer beware. Did that advisor put in you mutual funds? Did they put you in exchange traded funds, or did they put you in index funds? Let's talk about these, because I'm just going to be full disclosure, 1,000% prefer the exchange traded fund and index fund over mutual funds. And full disclosure, back in the day when I first got started, all of my clients' money were in mutual funds. And when I really learned I just thought it was robbery. I thought it wasn't fair. I was like, this is way too high in fees, that I made a transition. And I learned a lot of this from Yale and the finance professors there. It was very helpful, and it really just opened up my eyes. And I'm opening up the listeners' eyes to listen in here. This is key. The mutual funds, some of these mutual funds out there, they have Class A share mutual funds. They charge you a 5 to 7% commission up front. So if you put $100,000 in it, and the advisor is a transactional advisor, and it's a Class A share, and they get 5% commission or a load, that's what they also call them, your $100,000 starts with only $95,000. That advisor made their money. And then if they sell it again, guess what? We call this journey. And then they're going to charge you another commission.
Wow.
But there are mutual funds that don't have those loads, of course. But the ones that don't have those loads, a lot of times we find out they have high internal expenses. So the advisor, for example, I love Fidelity. I use Fidelity. But if you go directly to Fidelity, Randy, that advisor is going to charge you 1%. And then they're going to use Fidelity funds like the Blue Chip Mutual Fund, which we love Blue Chip. We love Fidelity. Everything sounds great. But guess what? Fidelity needs to get paid too. And they charge 0.97%. That's almost 1%. So you're 2% out the door. That is ridiculous, whether it's a Class A commission or just a double fee. No way, Jose, in retirement. I don't like it. And you know what I did? I made a change when I became very clear and aware of what was going on in the financial services industry. So I moved over to exchange traded funds and index funds. And I am so confident I can brag about this and toot my horn, because it is awesome. Because exchange traded funds and index funds are basically the same as a mutual fund. But the difference is these big banks and brokerages at every stoplight you go to, the big ones, they can't put their fees inside of them, so they're not going to offer them. Therefore, you don't have them in your portfolio. And if you do, it's a very small amount. So exchange traded fund and index funds, there's no commissions inside of them, right? No commissions. So you already know, you're like, oh, good, I don't have to pay that 5 or 7% commission. Correct. On top of that, that internal expense that we talked about from Fidelity, the Blue Chip Fund, 0.97, on average, they are 0.5% or lower. So we're already saving 0.5% at least, in my opinion. And if you go with the index fund, which biggest part of my portfolio is in these, we're talking about pennies on a dollar, 0.001, 0.02. I mean, come on, it doesn't get any better than that. So think about it, look at your statements, and then start questioning, open up your eyes, start planning for retirement, start planning to save 0.5% in fees. I'm telling you, you will not regret it. So now you've moved your 401k to an IRA Roth. Now you know that's the next investment strategy. You get to pick. And so later on down the road, if you get upset, you're like, yeah, I heard it, but I didn't listen to it.
one of the things that you've taught me about this is that there can be an ABC fund in your 401k, and you look at all the holdings in there, and then you look at the XYZ fund, which is an ETF, and they have exactly the same holdings because everybody's putting their money in Apple and everybody's putting their money in Microsoft because that's where the money is. But you find that ABC has a big fee and XYZ doesn't. And it's the same holdings. And all you have to do is have somebody who can guide you through that process and kind of show you that. And that's what the portfolio analysis does.
It does. And then, number 3, let's talk about your stocks. You got a stock jock and they put you in some mutual funds and they put you in some glorious stocks. We love stocks. Good. We want stocks. We do want to be careful what we put in there for stocks, though. When you might think, oh, my advisor doesn't charge me a fee, but there's something called sales charges in stocks. When they buy the stock, they make 1, 2, or 3%. When they sell the stock, they make 1, 2, 3. You know what I mean? Mm-hmm. So, and then if you say you work with a fiduciary advisor and then they're putting you in more index funds or certain things like that, you can look at the QQQ. Then there's also the QQM, and then the's the TQQQ, right? Which one do you get in? Do you know that
you've lost me? I don't know.
I know. So this is just an exchange traded, an index fund, exchange traded fund type funds. There's 3 versions of which one should you go in.
Okay.
Do you know one is like triple in fees versus the other?
Wow.
One is there's more risk to it, but they're the same, which is crazy to me. So why would you go into the QQQM over the QQQ? Right? I know it's confusing. This is the stuff I know. I would never put the latter 2. I'd put the first one in because it just saves so much fees to our clients. So know that it's out there. It's called bid and ask. It's all about the bid and ask and these sales charges. And that's what I will coach you up in our classes when you come into our classes and or if you come into my office. So that was number 3.
As Tony Robbins said, if you were listening earlier, a lot of people don't even realize they pay fees within their 401ks. So they pay fees within their investments. Sometimes you pay on the way in when you buy. Sometimes you pay on the way out when you sell. Sometimes you pay both. And sometimes there's fees in there that are built in that are really hard to find. And one of those places, and one of the reasons people are against annuities, is because some of them have high fees. So, Charisse, let's go into this topic.
There are good annuities and there are bad annuities. Let me do some comparisons for you. So the people out there that are naysayers about annuities, I just don't know if they're educated in them. Maybe they had a bad taste in them. They don't understand what's out there anymore. It's crazy to me. They keep their head in the sand and they never go back, and they're hurting their clients, but not considering it as an opportunity. So there's 4 annuities. There's the immediate annuity. There is the variable annuity. There is the fixed annuity and the indexed annuity. And I'm going to go through a yellow light, red light, green light. And we're going to start with the yellow light. Okay, it's warm. I'm okay with it. Is there something better? That's the immediate annuity. So if you have a pension and you didn't take the lump sum option, they gave you an immediate annuity. You annuity forfeited the principal to get this beautiful income for the rest of your life and hopefully for your spouse's life. But there's nothing left for the kiddos, right? But you did it to have higher income. And so you could have rolled those to an IRA and also got an immediate annuity and got an income. And you could even left some to go into an investment plan and leave as a legacy. I'm okay with those. It's a yellow light. There's a better way today. Things have changed. Let me go on to my red light because this is the one that really bothers me. It's called the variable annuity. The variable annuity is the stock market roller coaster. It is junked up in fees. I am not sure how they're even legal, to be honest with you, but let me explain why I have that feeling. A variable annuity, you go to a workshop or a dinner seminar and they do this wonderful sales presentation and tall, dark, and handsome, sounds good, smells good, and looks good, but are they really good, or what they're offering, is it good? The variable annuity on average starts out with a 3% fee. And I've seen them as high as 5 to 5.5% in fees. We're talking about a mortality and expense fee. It averages 1. We're looking at a fund fee that averages around 1. We have an admin fee. We have an income rider fee. Holy moly. On average, they're about 3 to 4%, right? But what happened is these big white ivory towers, somehow they got away with, let's create a new version of a mutual fund and let's put this pretty little wrapper around it because everybody thinks annuities give income and they're safe and charge all these fees, yet have that annuity wrapper around it. We call it a variable annuity. And once upon a time, they actually really good. They were great, but they've changed over time. And You might have bought that annuity and didn't ask all the right questions, but the advisor or the insurance agent who was selling it to you said, hey, don't worry about the stock market roller coaster. Don't worry about the fees, which you'll never get the answer to the true fee in those till you come to my office. You're going to get a doubler. You put $100,000 in here right now. It's guaranteed no matter what to double to $200,000. You're like, oh, wow, that sounds great. 10 years later, you call the insurance company and it's like, hey, we're ready to cash out our 200,000. Even when the market's down, 40%, I still get my 200 grand. And I'm like, oh, I'm sorry, Mr. or Miss Jones. You can't take that. That's funny money. That's, you heard of Fugazi. That's fake stuff. It's not real. You can't cash that out. I'm sorry you didn't understand that. So like, what can I do with it? Well, you can take a 4% withdrawal from it for the rest of your life. You're like, oh, well, okay, we'll do that. So I'm just like, it's not worth it, because once you start taking your income in one big market meltdown, all the while all these fees are hitting you at one time, there's likely not to be a death benefit for your beneficiaries. To me, it doesn't make sense. So I give it a red light. Now, I'm going to start with the first green light. If you liked that kind of annuity and you like that doubler and that guaranteed income stream for life, then you go with a different type of annuity. We call it the hybrid annuity, also known as the fixed index annuity or even the equity indexed annuity. The fees are only 1%, right? Maybe 1.1. So you're going from a 3 to 4% fee to a 1.1 to get the same thing. The difference is now there's no roller coaster ride. Those account values can never go down because it's a safer annuity. So whatever you put in, it's always locked in, and the interest you make every year, it's locked in. It can't go down. You're only being hit for 1% fee because you want that double. You want to double no matter what in 10 years so you can take that income for life for you and your spouse. The nice thing is that income for life for you and your spouse, the newer versions, the new age index annuities, guess what? The payout percentage after 10 years, what I've seen has been higher than the variable annuity. So if the variables only give you 4 to 4.5, and the index annuity, that hybrid annuity, can give you 5 to 5.5, it's still the better version. And then we don't have a roller coaster ride. And then we possibly have more money as a legacy lasting longer, right? So things have changed and they've evolved. So I give that one a green light. So we started with the yellow light, the immediate annuity, the red light, the variable annuity. And then the first green light is the indexed annuity with the income rider if you needed it. Not everybody needs that. I don't believe in fees and annuities, but if you need it, I'm going to let you know. And the double green light, let's just talk all we can about this, is just a simple fixed annuity. Right now, the opportunity of getting a 6.15% return every year guaranteed for the next 5 years with an A-rated company that gives you liquidity. You can take 10% a year if you wanted to. That blows away any CD today, blows away the treasuries, and you've got that fixed return guaranteed for the next 5 years, no matter what the interest rates do in the future. If they come down, you're not going to find CDs at 5% anymore, right? But you surely are going to be locked into this. So this gets the triple star rating at Zinnia Wealth Management right now. We weren't offering these 2 years ago because they weren't on the top of the list, but 6.15 when we're only trying to average 4 to 6% over the next 5 to 10 years. Hello, there's nothing bad here, right? You can't lose. There's no advisor fees. You don't have to worry about bonds. You can replace these with your bonds if you want to. And we want A-rated companies. If you listen to the Susie Orman piece that we talked about the first half hour of our show, go to our podcast, you'll hear about what she's saying, and she's all positive about those, right? So all the naysayers out there, you need to start considering what is really out there and what is to be true versus what is not to be true.
Well, one of the things that you are going to get when we do a portfolio analysis, an x-ray for you, is what are you paying in fees? And as Tony Robbins said, many people don't think they pay any fees. They think that, Fidelity, what a wonderful company. I put my money there, it grows, and I retire, and everything's roses. Well, they're taking their cut, and you need to know what their cut is. And can you do something about that? That's what Charisse is talking about today. Let's find out what you're paying. Let's see if we can reduce that number and put more of that money in your pocket. That's one of the things that comes out of your complimentary retirement consultation. Go to our website, zinniawealth.com, ZINNIA wealth.com, and there's a gold box there. It says complimentary retirement consultation. Click on that. You'll be on your way.
Thanks for listening to the Retirement Coffee Talk podcast. If you have questions or would like to begin the process of building a tailored retirement plan, call Zinnia Wealth at 803-368-3680 or find us online at zinniawealth.com.
Sharice Rivers is an investment advisor representative of Zinnia Wealth Advisory, LLC, a registered investment advisor. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Financial professionals are not licensed in all 50 states. To find out if Sharice Rivers is licensed in your state, please contact their office. Zinnia Wealth Advisory, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. Any client experiences discussed during this show are unique to that client. They are not meant to imply or suggest you will experience the same results. By contacting us, you may be provided with information about insurance and annuity products offered through Sharice Rivers, NPN Insurance License Number 8718011.